If you want to find a stock that, multiplies your money tenfold, you'd probably just look for a company with skyrocketing revenue.
Oh, absolutely.
Yeah.
I mean, it seems completely intuitive to do that.
Yeah, but according to this massive statistical study of over 400 multi-bagger stocks, you would actually be looking in exactly the wrong place.
Completely the wrong place.
So today, we're doing a deep dive into the 2026 playbook for finding what are known as shining stars. We're exploring why the traditional metrics that, everyone obsesses over are actually leading retail investors straight into a trap.
Yeah, because the modern retail investor has this massive surplus of market access, right? But they have a severe deficit of actionable structural insight.
Right, you can just open an app and buy equity in 2 seconds.
Exactly. But you are instantly buried under algorithmic trading spikes, options hype, and just endless social media noise. We were trying to cut through all of that today.
And to do that, we are diving deep into Dr. Prabhat Kumar's 2026 enhanced edition of Spot Me as the next shining star.
Such an interesting text.
It really is. Our mission for this deep dive is to extract his systematic framework for finding these high-quality, high-compounding businesses. And he does this by combining, the timeless principles of value investing with 2026-era artificial intelligence.
Which is a very potent combination.
Okay, so let's unpack this, because traditional fundamental analysis, it used to be like hand mining for diamonds, right? You read the annual report, you looked at the margins, and you just made an educated guess.
A lot of manual labor.
Yeah. But what Dr. Kumar is offering with this AI-enhanced workflow is essentially a fleet of AI-powered excavators.
I like that analogy.
Thanks. I mean, the AI can instantly dig through mountains of data to find the anomalies, but it still requires you, the human, to actually verify the gems, right?
That is a highly accurate way to frame it.
Yeah.
But before we get to the excavators, we really have to establish the baseline of what we're actually digging for.
Right, because we aren't just gambling here.
No, not at all. Trading on margin or chasing meme stock hype, that is speculation. Buying intrinsic value with a margin of safety, that is intelligent risk-taking.
Which is exactly what we are optimizing for today.
Exactly. So Dr. Kumar builds his entire framework on an updated version of Warren Buffett's 4 classic pillars of value investing. But, modernized for an era where data is basically infinite.
Okay, so what's the first pillar?
The first pillar is understanding Mr. Market. That's the concept that the market swings wildly between irrational fear and excessive greed.
Which historically meant you just had to kind of feel out the market vibe, right? Like you read the newspaper and tried to guess if people were panicking.
Right, but not anymore. AI takes that qualitative vibe and turns it into quantitative data.
Oh, wow.
Yeah, instead of guessing, you can use a large language model to run real-time sentiment analysis on millions of unstructured data points.
So, what kind of data are we talking about?
We are talking about scraping global supply chain manifests, tracking localized sentiment on consumer forums, and crucially, monitoring complex promoter pledging trends.
Wait, tracking promoter pledging?
Yeah, across shadow banking networks. So if a company's founders are quietly pledging their shares as collateral for loans, the AI spots that liquidity risk instantly.
That's crazy.
It quantifies exactly how vulnerable that stock is to a sudden margin call.
So it totally changes the game from just reacting to the news to actually preempting the underlying stress.
Exactly. But knowing the market's mood doesn't tell us what the business is actually worth. Which brings us to the second pillar, intrinsic value.
Right. I mean, I know people who spend days building discounted cash flow models in Excel, just tweaking a growth rate by 0.5% to see what happens.
And that static modeling is exactly what AI replaces. You can now use AI to run Monte Carlo simulations in a matter of seconds.
Monte Carlo simulations?
Yeah, instead of a single Excel projection, the AI runs 10,000 distinct macroeconomic scenarios. Easily. It stress tests the intrinsic value against variables like sudden interest rate spikes, global shipping route closures, or, a localized recession in a key market.
So it gives you a whole range of possibilities.
Right. It gives you a probabilistic curve of what that business is worth, rather than just a single fragile guess.
But I mean, if the AI simulation is wrong by 20%, how do you ensure you don't just lose your shirt?
Well, that's where the third pillar, the margin of safety, comes in. You never buy a business at the exact intrinsic value the simulation spits out.
You want a discount.
Always. You demand a discount, usually around 30%, to absorb those unknown unknowns.
Right, that makes sense.
And the final pillar, which is often the hardest to actually maintain, is a long-term horizon. We are biologically wired for instant gratification. right? So it makes it agonizing to hold a stock through a 20% drawdown.
Let me push back on this whole setup for a second, though.
Sure, go ahead.
If this AI is like this incredibly capable system that can track shadow banking liquidity, run 10,000 simulations, and filter out daily noise to focus on megatrends,
Yeah.
why am I even involved? Why not just plug the LLM directly into my brokerage API and let it execute the trades while I go play golf?
I mean, it is a very tempting thought. But Dr. Kumar warns explicitly against complete automation.
Why is that?
Because AI is a powerful analytical engine, but it is not an oracle. And it suffers from a fatal flaw, which is hallucination.
Oh, right. Making things up.
Exactly. It can confidently present totally fabricated financial metrics if your prompt isn't perfectly constrained. Furthermore, AI lacks a fundamental understanding of on-the-ground reality.
What do you mean by on-the-ground reality?
Well, it cannot comprehend the subtle cultural rot within a specific corporate management team. It doesn't know what it actually feels like to walk into a company's retail outlet and experience really apathetic customer service, or to see dilapidated inventory on the shelves.
I see. So the AI is basically the junior analyst grinding through the SEC filings at 2 a.m.
That's a perfect way to put it.
It highlights the anomalies, builds the models, hands you a dossier, but you, the human, are the portfolio manager.
Exactly. The final fiduciary call and the actual conviction required to hold the asset when the market panics, that rests entirely on your shoulders. You are outsourcing the computational heavy lifting, not the judgment.
Okay, so we have the workflow established. We know how to deploy our AI analyst. The next hurdle is defining the target.
Right. What are we looking for?
Because if I am going to the trouble of running Monte Carlo simulations, I need a return that justifies all this effort. Otherwise, why not just buy a low-cost S&P 500 index fund and accept the baseline compounding?
Well, baseline compounding is foundational, sure, but the mathematical reward for finding a true shining star, a stock that compounds at 15 to 20% annually, is just staggering.
The math in the source material is wild on this. Let's walk through it.
Let's do it.
Say you invest 1 lakh today. At a standard, very respectable 8% index return, that 1 lakh becomes about 10 lakh in 30 years.
A tenfold increase, which, most investors would be thrilled with.
Totally. But if you apply this AI framework and capture a sustained 15% compound annual growth rate, the trajectory just goes vertical.
It really does.
That same 1 lakh becomes over 66 lakh. And if you hit a 20% CGR, it explodes to between 66 and 237 lakh.
It's life-changing.
You are moving from a comfortable retirement to creating multi-generational wealth.
Which brings us back to your opening point. Finding those specific compounders requires knowing what traits actually predict that kind of growth.
Right.
And Dr. Kumar leans heavily on the Yartseva statistical framework to define these traits.
And just to clarify, that's a massive study of 464 high-performing multi-bagger stocks. Right?
Exactly, 464 stocks. And this study completely shatters the mainstream consensus.
Yeah, because the financial media trains us to look at top-line revenue growth as the ultimate indicator of success. Like, if revenue's doubling, the stock must be a winner.
But what's fascinating here is that the Yartseva study proves revenue growth is often a trap.
A trap?
Yeah, because a company can artificially manufacture top-line growth. They can slash their prices to the bone or burn billions in totally unsustainable marketing spend.
Oh, right. Buying growth.
Exactly. The revenue goes up, but the margins are destroyed, and the business is just bleeding capital.
So what is the best predictor, then?
The strongest single predictor of a multi-bagger isn't revenue. It was a metric called free cash flow to price, or FCF over P.
Okay, explain the mechanism behind that. Why is free cash flow the absolute ultimate signal?
Well, free cash flow is the actual surplus capital a business generates after paying for all its operating expenses and all the capital expenditures required to just maintain its current assets.
The actual cash left over?
Right. So when a company has high free cash flow relative to its stock price, it proves that the underlying unit economics are highly profitable.
Without needing a bunch of outside debt.
Precisely. Cash is absolute reality.
The study also highlights a crucial size factor, which I found super interesting. The median starting market capitalization for these 10x multi-baggers was surprisingly small.
Very small, hovering right around $348 million.
Why is that?
That comes down to the undeniable physics of scale and the law of large numbers.
Okay.
If you are a $300 million software company, landing a few major enterprise contracts or expanding into just 2 new states can literally double your market size.
Right. It doesn't take much to move the needle.
But if you are a $2 trillion mega cap tech giant, you have to conquer entirely new continents or invent a revolutionary new product category just to grow by 10%.
You just need a massive, unpenetrated runway to multiply your size tenfold. That makes total sense.
It does. But there was also a major red flag identified in the Artseva study, which is the concept of corporate bloat.
Ah, corporate bloat.
Yeah, the data showed that companies where asset growth outpaced EBITDA growth routinely failed to become multibaggers. Big does not automatically equate to efficient. In fact, it often means the opposite.
Here's where it gets really interesting. Think of corporate bloat like a logistics company that suddenly decides to buy a massive fleet of 500 new delivery trucks.
Okay, good analogy.
From the outside, their asset base looks huge, right? And the business looks like it's booming. But if their operating profit, their EBITDA doesn't rise proportionally, it means those new trucks are just sitting in a parking lot depreciating.
Exactly.
They are paying for maintenance and insurance, but the assets aren't generating surplus capital. So it's capital expenditure without capital return, creating this really sluggish, bloated balance sheet, like eating too much junk food before a marathon.
That analogy hits the core mechanism perfectly. When a market shock occurs, that bloated company doesn't have the agile free cash flow to actually survive.
So our mandate is clear. We want highly efficient cash-generating companies with a small enough base to allow for massive compounding.
Right.
But the practical challenge is spotting these needles in the haystack of global equities. And that assumes the financials are honest to begin with.
Which is a big assumption.
Right. Corporate management teams are practically incentivized to obscure their weaknesses in annual reports. So how does our AI junior analyst not just fall for the CEO's glowing narrative?
This is where Dr. Kumar's specific 10-point scorecard comes into play. It heavily weights metrics that strip away accounting illusions. So let's look at how the AI evaluates the balance sheet.
Yeah, one of the biggest red flags the AI is prompted to hunt for is a divergence between trade receivables and revenue.
That is a classic forensic accounting tripwire.
Right.
Trade receivables represent money owed to the company by its customers for goods that are already delivered.
Okay.
So if a company claims their revenue is skyrocketing by 40%, but their trade receivables are growing at 80%, the AI flags a critical failure.
Because it means they aren't actually collecting the cash, they're just owed the cash.
Precisely. It often reveals a practice known as channel stuffing.
Channel stuffing, right?
Management forces excess inventory onto their distributors at the end of a quarter, offering massive credit terms just to make the current period's sales numbers look exceptional.
Just to hit their bonus targets.
Exactly. The revenue is booked, but the cash never actually hits the bank. An LLM instructed to cross-reference those specific lines will catch that discrepancy in milliseconds.
And the same logic applies to the income statement. Companies love to dress up their profit after tax, their absolute bottom line, using one-time exceptional items.
Yes. A struggling manufacturing company might sell off a prime piece of real estate they've held for 40 years. Suddenly, their quarterly net profit looks historically fantastic.
But it's totally misleading.
Because that isn't recurring operational success, it's just a liquidation of assets. So you prompt your LLM to normalize the earnings, explicitly instructing it to strip out all non-recurring income and isolate the core EBITDA margins.
Which brings us back to the golden rule. Cash is fact, profit is opinion.
I love that phrase.
Yeah. A company can report record profits on the income statement while simultaneously going bankrupt because they ran out of actual liquid cash.
To synthesize all these checks and balances, the 10-point scorecard assigns specific weights.
Okay, break that down for us.
Fundamentals, like return on equity and free cash flow, carry a 20% weight.
Makes sense.
The business moat, balance sheet strength, management quality, and valuation each get 15%.
Okay.
And finally, industry tailwinds and near-term catalysts get 10% each. Dr. Kumar suggests only considering companies that score an 8 or higher.
So how does an ordinary investor actually execute this workflow practically? Like, you don't just dump a 300-page PDF into a chat window and say, hey, is this stock good?
No. The workflow is highly structured. Step 1 doesn't involve AI at all.
Oh, really?
Yeah, you use a traditional quantitative screener, like screener.in or ticker tape, to apply hard baseline filters. You screen the entire market for companies generating a return on equity greater than 15%, with a debt-to-equity ratio strictly below 0.5.
So we filter for high profitability and low leverage right out of the gate.
Exactly.
That narrows thousands of public companies down to a short list of maybe 100.
Exactly. Then step 2 is feeding the annual reports and quarterly earnings, call transcripts of that specific shortlist into an advanced LLM, like Claude or Grok.
Using a specific prompt?
You use a highly specific engineered prompt. You command the AI to act as a forensic auditor, grading the company against the scorecard parameters we just discussed.
Forcing it to show its work, basically.
Yes, forcing it to cite specific page numbers and highlight accounting anomalies.
So the output is a highly curated list of potential shining stars. But let's move from theory to reality here. The source material applies this exact workflow to the 2026 Indian Advanced Technology, or AT, sector.
Right, the AT sector.
This space is notoriously full of speculative hype, but it also contains genuine compounding engines.
The AT sector case studies are incredibly revealing because they demonstrate how the scorecard filters out the noise. Let's examine Oracle Financial Services Software, or OFSS.
According to the analysis, OFSS is a masterclass in capital efficiency.
It really is.
They provide the deeply embedded, mission-critical IT infrastructure for global banks. And the scorecard flagged them because they operate with zero debt, maintain a staggering 51.65% operating margin, and generate massive return on equity.
They aren't burning cash to acquire customers. Their enterprise software is so essential that the switching costs for their clients are virtually prohibitive.
Once you're in, you're in.
Right. That creates a massive protective moat. Then you contrast that with Apple 3i, which highlights the Yartsev advantage of starting small.
So Apple operates in the digital advertising space, but their business model is entirely different from the legacy players. They use a cost per converted user, or CPCU, model powered by AI.
And this is a crucial distinction in the mechanism of their business. Traditional digital ads charge based on impressions.
You pay every time someone sees the ad, regardless of whether they buy anything.
Exactly. But Apple's AI model charges advertisers only when a user actually converts or makes a purchase. It aligns their revenue directly with the client's success.
And the financials actually reflect that. I mean, they boast over a 47% revenue compound annual growth rate. They are virtually debt-free, and they have that small cap runway required for massive scale.
What's fascinating here is that if we connect this to the bigger picture, a stark pattern emerges across all the case studies.
Including the digital engineering firms like Persistent Systems and LTTS, right?
Yes. None of these companies are speculative, pre-revenue hype machines hoping to figure out monetization 5 years from now. They are deeply profitable, cash-generating enterprises today. They bridge the gap between digital AI themes and real-world implementation.
Like Bosch India's auto sensors.
Precisely. But even if you find a brilliant company like Apple or OFSS, the rules of value investing still apply. You can't just pay any price.
Right. Valuation is the ultimate anchor.
The Yartsev rule dictates that overpaying destroys multi-bagger potential. You still must evaluate the PEG ratio, the price-to-earnings growth ratio. You are looking for a PEG of less than 1.
Let's break down why the PEG ratio is so critical. If you pay 50 times earnings for a company growing at 20% a year, you have mathematically priced in a decade of flawless execution.
Perfection is priced in.
Right. If they stumble for even one single quarter, the market compresses that multiple and the stock price collapses, even if the underlying business continues to grow.
So a PEG below 1 ensures you are actually getting growth at a reasonable price, preserving your margin of safety.
Okay, so what does this all mean for portfolio construction? Let's say you run the screener, the AI audits the financials, the scorecard is a 9 out of 10, and the PEG ratio is 0.8.
You found a winner.
You have found a verified shining star. Do you liquidate your life savings and go all in on this one ticker?
Absolutely not. Identifying the asset is only the first step. Surviving the inherent volatility of the market to actually harvest those compounding returns requires a rigid, risk-adjusted portfolio framework.
So Dr. Kumar outlines a very specific allocation pie. He dictates 30 to 40% in a blue-chip core for foundational stability, then 20 to 25% in steady growth compounders, 20 to 30% allocated to your multi-bagger stars. These are the high-conviction ideas you ran through the scorecard. And finally, a mandatory 10 to 15% in a cash buffer.
Notice the deliberate concentration in the shining stars allocation. Dr. Kumar advises holding a total of just 10 to 20 high-conviction names across the entire portfolio.
Why so few?
This combats the common retail trap of over-diversification.
Right. If you own 100 different stocks, you haven't built a high-performance portfolio. You've just built a very expensive, high-effort index fund.
Exactly. You need concentration to generate those massive returns and diversification only to protect against catastrophic loss.
But I have to ask about that 15% cash buffer. Holding cash in an inflationary environment, I mean, it feels like a constant drag on returns.
It is a drag in a bull market, but if we connect this to the bigger picture, you have to reframe how you view cash. Think of that 15% cash buffer like holding empty warehouse space in a global supply chain.
Okay.
Yes, paying for empty space costs you money in the short term. But when a massive macroeconomic shock hits and the global supply chain freezes, every other company is paralyzed.
But you have the space.
You have the strategic capacity to buy up distressed inventory at pennies on the dollar. Cash isn't just a safety net, it's a weapon.
A weapon to deploy when high-quality businesses finally offer that 30% margin of safety.
Exactly.
So what does this all mean? It means building a portfolio is a lot like building a sports team. You need your reliable defenders, which are your blue chips, your steady midfielders for growth, and a few star strikers, your multibaggers, plus some bench depth and cash for when injuries happen.
That is a brilliant way to summarize it.
Well, let's recap this entire system. We started with the overwhelming noise of modern trading and introduced Value Investing 2.0.
Using AI to filter the noise.
Right. We explored how to utilize LLMs to run dynamic intrinsic value simulations while firmly keeping human conviction in the driver's seat.
Very important.
We looked at the underlying physics of compounding, learning why free cash flow to price and a smaller market cap are far superior metrics to raw revenue growth. We walked through the 10-point scorecard and finally learned how to structure a concentrated, risk-adjusted portfolio.
It is a remarkably robust architecture for the modern era.
Yeah.
But, analyzing this framework in its entirety raises a critical, almost philosophical question. One that isn't explicitly resolved in the book, but logically follows this technological trajectory.
All right, let's hear it.
If Dr. Kumar's AI-augmented frameworks, these specific LLM prompts and these forensic screening tools become the standard baseline practice for every retail investor by the 2030s,
Yeah.
will the stock market become perfectly efficient?
Wow, wait, really think about that. If every single investor has an AI MRI machine instantly flagging accounting anomalies and calculating probabilistic value, the structural advantage disappears.
Precisely. If the technology levels the playing field so that everyone instantly recognizes a fundamentally sound shining star, will the very concept of a margin of safety vanish entirely?
Because market prices will just instantaneously adjust to perfection.
Exactly. Which implies that the ultimate advantage in the future won't be computational. Everyone will have the same data and the same AI models.
So what's left?
The final unbeatable edge might be pure behavioral psychology. The human discipline to endure gut-wrenching volatility and hold on to your convictions when everyone else's algorithms are triggering automated panic selling.
That is wild to think about. The tools evolved exponentially, but human nature remains stubbornly constant.
Very true.
And that brings us right back to the beginning. You holding your phone with the entire global market accessible in 2 taps. The analytical tools are more powerful than they have ever been in financial history, but the emotional discipline required to actually build generational wealth is still entirely up to you.
Absolutely.
Thank you for joining us on this deep dive. Your homework for this week: take one stock you've been closely watching, run it through a baseline screener, and prompt an LLM to evaluate its free cash flow and trade receivables. See what the MRI scan actually reveals. We'll see you next time.
Hey everyone, welcome to This Explainer. I am absolutely pumped about today's topic because we're looking at a framework that completely updates classic investing for the modern era. We are going to break down Dr. Prabhat Kumar's fantastic guide on Value Investing 2.0. He basically shows us exactly how to use today's AI tools to supercharge those timeless principles of value investing. So our main goal today? To really understand his data-driven blueprint for finding multi-bagger stocks, the ones he calls the true shining stars of the market.
Okay, let's dive right into this blueprint. Here's our masterclass roadmap. We'll start off with mindset and myth busting, explore the math of wealth, crack open the AI toolkit, break down the exact formula, look at a real-world proof of concept, and then wrap things up with risk and reward.
All right, Section 1, Mindset and Myth Busting. This is really the foundation of Value Investing 2.0. So is the stock market just gambling? I mean, it's a provocative question, right? And honestly, you hear it all the time. Is the market just a giant casino? Well, the answer is a resounding no, assuming you actually know what you're doing. If you're trading without knowledge, just blindly following social media tips, or using crazy high leverage, yeah, for sure, that definitely has a negative expected value over time. But investing in high-quality businesses at fair prices where you have a probabilistic edge, that's totally different. That is intelligent risk-taking. So the crucial point here is understanding the stark difference between pure speculation and true investment. Speculation, that relies on hype, price movements, leverage, and, well, a whole lot of hope. Investment, on the flip side, requires deep analysis, a strict margin of safety, and a genuinely long-term view. And here's the best part about this modern framework. AI is your tireless research assistant. Now, it doesn't need to sleep, and it certainly isn't a crystal ball that predicts the future, but it amplifies your analysis so you can step up and act when others are panicking or getting overly euphoric. Moving on to Section 2, the math of wealth, and why time and rate of return matters so much. We absolutely have to start with compounding. Albert Einstein supposedly called it the eighth wonder of the world, and Dr. Kumar makes it super clear that it is, without a doubt, the single most powerful force in wealth creation. When you buy into high-quality businesses that consistently grow their earnings and you let those returns reinvest over time, your wealth doesn't just grow in a straight line, it explodes exponentially. It's like a giant snowball rolling down a hill. Time and consistency are the real secrets here. And the math behind this is just staggering. To put this into perspective, over 30 years, a standard 8% index-like return on a 1 lakh investment grows into a respectable 10 lakh. Not bad, right? But if you apply superior stock selection to find those shining stars, pulling in a 20% return, that exact same 1 lakh investment generates over 237 lakh? No way, right? It's a massive, literally life-changing jump. And it really shows why putting in the rigorous research to find even a few of these compounders is totally worth the effort. All right, Section 3, the AI toolkit, or how we go about supercharging fundamental analysis. When you're out there hunting for these compounders, you need to quickly break down the big 3 financial statements. First, ask your AI to check the balance sheet to make sure they aren't dangerously leveraged. Ideally, you want a debt-to-equity ratio under 0.5. Next up, look at the income statement. You're looking for improving profit margins as the company scales. And finally, check the cash flow to make sure they're actually generating more cold, hard cash than they need to just keep the lights on. To make this actionable, here's a fantastic little hack straight out of the source text. You can feed your favorite large language model this exact prompt to have it act as your own personal forensic accountant. Actually, it's incredibly simple. You literally just paste in the financial data and tell it, review the following financial excerpts, flag any unusual trends, aggressive accounting, related party issues, or pledging. Boom. What used to take a human analyst days of grueling reading can now instantly highlight hidden risks or major red flags, saving you a ton of time. Section 4, the formula. Let's look at the Shining Star scorecard. Let's see how this all builds into a complete picture. Notice that hard fundamentals carry the most weight here at 20%, followed pretty closely by moat, balance sheet, management quality, and valuation, all at 15%. Then, industry tailwinds and upcoming catalysts round out the rest. By feeding your data into an AI and cross-referencing it with your own research, you can score a company across these exact metrics. Your target? You're hunting for those rare gems that score an 8 or higher out of 10. Now, when a company actually manages to score an 8 or higher, it often follows a really fascinating journey. It kicks off with discovery and the analysis of its strong fundamentals. Next, you usually see an initial re-rating as the broader market finally wakes up to its quality. Following that is often a period of consolidation and volatility, which frankly shakes out the impatient investors. But eventually, as the business really scales up, it leads to massive, long-term wealth creation for the folks who held on. Okay, Section 5, Proof of Concept, Real-World Case Studies in the AT Ecosystem. 11.3. Now, you might be wondering, why is this specific number so incredibly important? Well, according to a massive 15-year study by Yartseva that's analyzed in our source, 11.3 was the median starting forward price-to-earnings ratio for actual 10-bagger stocks. This proves mathematically that you simply cannot overpay for growth. Securing a reasonable entry valuation isn't just a nice-to-have suggestion, it is absolutely crucial to achieving those massive multi-bagger returns. And what's really interesting here is that the same 15-year study found that pure revenue growth, it's actually not the best metric to follow. Who knew? Instead, free cash flow to price is the single strongest predictor of multi-bagger returns. High-quality compounders consistently improve their ability to turn paper profits into actual touchable free cash as time goes on. So, applying this data-driven lens to the Indian advanced technology ecosystem reveals some seriously fascinating potential stars. You've got persistent systems with their deep focus on generative AI, or Oracle OFSS, operating with literally zero debt. Then there's Affily 3i, innovating in small-cap AI advertising, Bosch seamlessly integrating digital AI with physical mobility, and L&T Technology Services dominating the digital engineering space. What ties them all together? They perfectly combine strong AI tailwinds, squeaky clean balance sheets, and really high capital efficiency. Finally, Section 6, Risk and Reward. It's time to build your star portfolio. Now remember, risk isn't just about price volatility. It's about the permanent loss of capital. And to prevent that, this allocation strategy smartly slices up your risk. A solid 40% is dedicated to a blue-chip core for stability, leaving room for reliable growth compounders, and then a 25% allocation for those high-conviction multi-bagger stars. But crucially, and do not ignore this, keep a 15% cash buffer. That cash is basically your ultimate weapon, allowing you to scoop up great companies at amazing margins of safety when the market inevitably takes a dip. So we've covered the mindset, the math, the AI prompts, and the exact scorecard you need to spot the next shining star. You've now got a systematic, totally modern framework to leverage artificial intelligence for deep fundamental analysis. The only thing left? It's time to take action. So pull up your favorite AI tool, grab a company from your watch list, and let me leave you with this one question. What is the very first company you're going to run through the scorecard today?